Hi, everybody. This is Dan Sheridan from Sheridan Mentoring, and I'm going to start a little four-part series today on 0 days to expiration, the Greeks. I think it's an important topic in that the behavior of how options work when you put them on the same day and they expire the same day are quite different than if you're putting on a trade 10, 20, 30, 40 days from expiration. So I think it's good to focus on that a little bit. And the first part series today will be delta and gamma of 0-day options. And if you look here right now, today, what is this, May 23rd, as I'm looking at this in the morning, SPX is around 41.80, down 10 so far. So if you look at an at-the-money option, what strikes me when you look at the delta of an option, and delta will tell you how quickly an option will change. So this is basically the at-the-money 41.80s is about $7. The delta's near 50, all right, but goes up $1. This should go up by about 50 cents. So go from, if this is near $7.20, or let's just call it $7, goes up $1, it should go to $7.50, goes down $1, it should go to $6.50, the amount of the delta. What's interesting with 0-day options, you can see if we just go 5 points down or 5 points up, the delta basically changes by over 10 points. And you'll find out in a second with a 24-day option, if we move 5 points in the SPX, delta only changed by literally 1, right? It'll go from 53 to 54 or something. So you say, well, how does that impact me as a retail trader? I mean, the price risk on 0-day options is tremendous. So let's look at delta and gamma, and you can see gamma tells you how your deltas are going to move. So if we're at 41.80, what's 41.80 here? And you say, well, how do I get at 41.80? How do I get from a 52 delta? If we go to 41.75, down 5 points in the SPX, the delta goes to 63, up 11. If we go from 41.80 to 41.85, the delta goes to 40. Obviously, the big factor is things cease to exist at the end of the day today. But this gamma here, you'll see, that's the answer. That shows how much they change. So the deltas will change. Every point in the SPX will change by 2. So if we're going 5 points down or 5 points up, 5 times 2 is 10. Roughly, they're changing by about 10, a little bit more, but these are theoretical Greeks. But that's what the gamma is telling you, is how much are your deltas going to change for 10 points. So you can see, and we're going to look in a second at an iron condor to see, practically what the heck does that mean. But, it's significantly different. Again, your deltas will change. You have this big gamma, so 5 points in the SPX, your deltas change by 10 points, which, if you're selling options, could be significant. Now, if we look just for perspective, if we go down to, let's say, 24 days, here's 24 days. And if we go to the at-the-money, the 41.80s, I mean, it doesn't even record a gamma, but they definitely has some. But you can see, if we go from 41.80 to 41.75, this went for the 0-day from like 55 to 45 or 44. It just moves by 1. So deltas don't change. It's a more stable relationship. So, if you're selling options in some capacity, credit spread, or the deltas aren't affected that much on a 5-point move. But in a 0-day, they will. I mean, you look at an expected move on a 24-day option is 155 points. an expected move on a 0-day option is plus or minus 14 points when we're at a very low VIX level of 1770. That would be higher if the volatility were higher. Now, let's bring in a practical example. If you look at, here's an iron condor that expires at the end of the day today. So if you look at this trade, we're currently around that 41.80, 41.81, 20 points up. It's a little bit more than the expected move for the day. And if I sell 20 points down, 41.60, and I'm buying my 41.50 puts as protection, 10 points away, and 42.10, 10 points out of the money, and the call's there. So you have a defined risk spread. It looks like it's trading at $1.40 credit. And because they're 10 wide spreads, your risk is $1,000 plus 140 for your credit. So about $860 for one contract of this. And we might be trying to make 10%. 10% of this would be around $80. So if I sold it at $1.40, I'd want to buy it back at 60 cents or something. And I don't want to lose much more than, I make. So if I lose 80, or if I make 80 cents, so I buy it back at 60, I don't want to lose more than let's say $1 or something like that. So if this were to get to 240 or 230, I'd get out. Simple risk me. I'm not going to do a lot of adjustments on this. Let's look at the Greek. So this says I'm 2 deltas short. Now we've moved up to 41.82, but you can see the gamma is minus 1.22. So if we go up even 7 points, right? My deltas get from 3 to 11. Well, if I took the 1.23, right, times 7 points, right, if we go from 41.83 to 41.90, right, that's 7 points. That's about 8, right? Right, so you're going to get shorter by 8 deltas on the way up, and on the way down, would that be 41? 74 would be about 8, and you're going to go from on the way down from minus 2 delta short to actually long, and those things aren't good. You can see from a visual, if this is where the price is, you can see, the sledding hill, as I call it, is very steep when you get these 0-day trades. So you have to be very careful. It's more about price risk than anything. I think the next in the series, I'll talk a little bit about volatility, then we'll talk about theta and other stuff. But I want you to just feel of how quick these deltas move against you, how quick, if you have an iron condor and you get short deltas on the way up and long deltas on the way down, whereas if you were 20 days out or 30 days out, it wouldn't be a big deal. But, again, that's why size matters on this. You want to do smaller size because the price risk is higher. So that's just a little bit of a discussion on delta and gamma for the first part of the series, delta and gamma on 0-day expiration Greeks. If you have any questions about what I went over today, you can send me an email, Dan@SheridanMentoring.com. Be happy to help you. All right. Thanks, everybody. Appreciate it.